afternoon, everybody. Welcome to your Wednesday edition of the TraderMerlin show. Feel free to let me know if there's any audio issues, and thank you for those that sent in help requests. What's interesting, something is actually taking over my audio levels and dropping them. In the platform, everything looks great, but I just did an audio test, which I'll try to do before every show, where I actually record a piece of the stream, output it, and should sound fine. Audio levels should be much better, and because it was recording so low, we're getting that clipping sound. So again, thanks for the feedback. Thanks to Mark, who came out to trivia last night. Hope you enjoyed that one. I always love doing trivia. Maybe I did get a question from you guys that someone asked me what was my favorite question I asked last night. If you guys want, maybe I'll do a little trivia for you a little bit later on. Let's dive into our topic du jour. Just to get this out of the way, obviously love the way things transpired, especially the way we talked about it yesterday. Remember, we looked at the NASDAQ and said, if this is truly going to roll over, the Dow, not important. The S&P was starting to roll over. The Russell already had, and we wanted that NASDAQ to start to break. And we got that NASDAQ drop today. A little bit of bounce near the end, but all in all, I think a pretty darn good day for anybody who was bearish. So I will get to the markets here. I have multiple questions that have come in on this topic, so let me just opine a little bit and get your feedback as well as mine on China's big problem. I said to the AI platform, I go, give me a bunch of vacant buildings with an ominous red sky. And the questions that came in on this one, really two of them. Number one was from Joe. It says, China data was bad today. What will the ripple effects be on the U.S.? And then John says, what's going on in China and what implications that have to the U.S. markets as well as other implications. So we talked about this a while back on Power Trading Radio with John O'Donnell, which was the housing crisis. And you guys might remember Evergrande, right? Evergrande was this giant builder over there, or I guess real estate firm or builder. I call him a builder, I guess, and developer. That's what I was looking for. They've been pretty much insolvent since 2021. That one had ripple effects to the crypto world as well, because some of Tether's bonds, people were questioning whether that might be an Evergrande. And now you're seeing the second largest one there, which was Country Garden, is now facing issues and potentially going to go insolvent and file for bankruptcy. So, you know what, the issue you have here with China is significant slowdown, economic slowdown, which of course impacts their overall economy and growth. Now, if you look at the numbers that they had for GDP back into 2010, 12, 13, 14, it was like 10% GDP rates, which is crazy. Well, how do you get that? You get those kind of GDP rates by constantly expanding and building things. And one of the topics we had with John O'Donnell back then was ghost cities, where you literally have cities where nobody's there. They've built the buildings, and if these ones were finished and people weren't even in them. Now, they'd sold them to people, but they just weren't moving in. It was considered investment property. So, it almost feels like this is going back to a Bernie Madoff type of situation where you convince everybody that you need to buy these houses. We're going to put in trillions of dollars worth of infrastructure, and they do. But right now, because there's no new buyers coming into the real estate market over there, there's no cash to help fuel the accelerated levels of debt. And all of a sudden, you're left with a situation that the U.S. government is in right now, which is we've got so much debt, we can't pay it. We're looking to sell bonds to the consumers, to people to service our debt. Well, good news is the government can make money out of thin air, and most likely China can as well. However, that may not bail out companies like Evergrande or Country Garden as this housing crisis comes to a head. That said, when you have an economic crisis where the workers that are working on these buildings aren't getting paid, then they have to do what? They have to spend less money in their respective countries. So that leads to further economic decline within those countries like China is experiencing right now. So I guess it says China is not allowed Apple phones to be used near any government buildings. Interesting. Didn't know that. That's an odd one. Anyway, I think there's a sense of loyalty. They'll probably go with their domestic phones over Apple, but who knows? Apple's got a pretty good foothold. So I guess, to John's point, what does this mean for the U.S. markets going forward? I don't think it's as dramatic as it is going to be for China's economy. Now, China overall is a very poor country. Obviously, they've got a lot of wealth concentrated with some people, but the masses, the general population, not very wealthy, not a lot of money there to go around. So I think that you'll see their economy slow down significantly with regards to growth, with regards to development, roads, infrastructure, all that's going to slow down. Here's a crazy trivia question for you guys. This one will blow your mind. From 1900 to 1999, the U.S. used a specific amount of concrete. So just imagine the amount of concrete in the entire United States used in 100 years. Just for trivia fun, how many years does it take for China to consume the same amount of concrete that we have consumed over that 100-year window of time. From 1900 to 1999, China consumes that much concrete in how many years? Just curious what you guys think. It's gonna kind of shock you a bit. So I think that what you're gonna experience is defaults. I think Evergrande is the first one, which is they're going through that process now. You're gonna have Country Garden, and then you're gonna have several other ones start to fall apart. Well, I'm not just, Pepe says I'm not sad for China. I'm not sad for any economy, really. What I feel bad for sometimes are just the average Joe people, because they'll probably be the ones who suffer with this, as they were expecting all this money to come in and build infrastructure, but it didn't really benefit their lives, right? You would think maybe it increased property value or something like that, but not much. All right, let's see. Thomasina says 25, Les 3, RG and Siraj and Joachim say 10. Lori says 35, Jimmy T. Les is the closest one. So the number that's been thrown around is every 3 years, China consumes as much concrete as the United States did in the last 100 in the 20th century. I read a great report from an analyst that went through and looked at all the data. It's a little over 2 years is how long it takes them to consume that much concrete. Mind-boggling that in 100 years, China consumes what we consumed in 100 years in 2.5 years. Remarkable. That should give you an idea of how quickly they're expanding. A couple reports I read a while back were showing cities with just freeways that just go off into the distance, and there's just nothing. They just stop because there's no money there to keep fueling those expansion projects. So, of course, that's going to be, not only is it going to be an eyesore for the country because of all this unfinished stuff, but in many cases, it's wasted resources because you built all this stuff out, but you didn't. I guess you felt that well of money was going to continue on forever. One of the statistics I read that over the last year, there's been a 33% decline in demand for these building producers, right? The products that they're building. So obviously, when you have that big of a decline, that's going to end up hitting the bottom line. And if those builders that are building these buildings have no money coming in and are unable to service their debt, they're going to go bankrupt. And I guess the ripple effects of that bankruptcy is the one that's the most curious. Who holds the debt on those buildings? I'm sure some of it would be, I'm sure there's some U.S. companies that hold some of the bonds on those properties. But as far as how's it going to hurt our overall economy, China produces most of the stuff that it consumes. Now, granted, they do import some stuff, but most of the goods and services that we enjoy, well, they're the ones producing it anyway. So the question is, do those goods and services start to slow down, or goods start to slow down, and the costs rise over here? I don't think so. I think you'll see some economic problems, but manufacturing, I think, will still continue on strong. There's going to be no real shortage of that unless we see global spending decline and our demand for that manufacturing goods and services decline. So I really don't think it's going to be that big. I think what you'll see is mainly a problem within China. You'll see more of an economic issue there, particularly with the commercial real estate and big buildings, just like I think we're going to experience here in the next couple years. As the COVID has taught everyone they can now work from home, COVID has been the greatest IT employee for every corporation, because now you're just like, okay, well, I don't need to have infrastructure at the office. You can go home and work from home. That is certainly having an impact. We talk about that in previous sessions, where a lot of the current issue we see with our housing market, our commercial real estate, may come to fruition as a lot of these regional banks have exposure to commercial real estate, and a lot of businesses pulling their leases. I mean, look, Nordstrom. I don't know how long their lease was at that building in San Francisco, but Nordstrom just said, we're out. I think it was Nordstrom's or Neiman Marcus. One of the big ones in this mall just said, we're out. And they're like half the mall. And I think you're going to see more and more of that in troubled areas where there's almost lawlessness, like San Francisco, and also in commercial real estate businesses where people just don't need to have an office. For Online Trading Academy, we had 2 massive floors. And then they consolidated down to 1 floor. And now after COVID, I mean, it's half of the top floor. They just don't need all that space. I haven't been to the office in months. No need for me to go back in. So certainly I think commercial real estate is going to take a hit, and it'll be different the way that impacts us versus impacts China. China got way ahead of themselves, and they have ghost buildings, a little bit different than what we have experienced here. So as Alan says, what did Alan say? All that concrete and no building codes. Buildings killed the volleyball team. Oh, I didn't know that. There's got to be some codes out there. You can't, no way. They can't. One of the interesting things I did see, which I'm changing topics here, You can probably go look at it on YouTube. I won't waste our time with that one today. But if you go to YouTube, it's like they built something like an 18-story building in 24 hours. And most of you are going to be like, I would never set foot in that building, right? You're like crazy. However, I think it's actually a brilliant model. What they did is they built a train track that goes right by the site. And they basically just loaded up train after train in modular sections. Basically, it's cubes. And they stack this thing like Legos. And they keep stacking and stacking and stacking and stacking and stacking. And they're all pre-designed. So when they drop the block, they just wire the plumbing in, the electrical, plug. And hopefully when that's done and designed, it's all done with code in mind. Of course, who knows what to expect from a Chinese construction project. But that was a pretty amazing one to see, that they built this giant skyscraper in 24 hours. It was really amazing. So check that one out on YouTube. All right, HexDex. Invest in China and kiss your money goodbye. Yeah, it's funny because I've had a lot of viewers over the years, not only on this show, but on Power Trading Radio, ask me, what are your thoughts about investing in China? Nope. There's really nothing you could do to get me to invest long-term in China. I just don't trust it. Even investing long-term period, I think I have a little bit of a difficulty with that one. So I am not a fan of investing in China. I don't trust the economic data. I don't trust the numbers, period. I could go and show you all sorts of charts and data about China. But you look at their economic woes. Real quick, who do you think is worse? Let me do a poll here real quick. Let's see. The question is, who has the worst debt to GDP ratio? And I'm going to give you two choices, USA or China. All right, so there you guys go. There's your poll for today. I'll get that one going as I maybe bring up some other charts for you, but just curious what you guys think, because you look at this stuff and you look at the infrastructure that China is building out, and you're like, man, they've got to be in massive debt. And they are. There's a lot of debt going on with China, but I don't know. I'm going to wait for your poll to see here. Now, the real truth is, do we trust the debt to GDP ratio numbers that are coming out of China? Do we even have a real clue? I don't know. Do we trust the debt to GDP ratio coming out of the United States? I don't know. I don't trust that stuff at all, but either way, let me bring up those numbers for you, and I will show you that one. So here, one second. I got to bring up two different sites. Multitasking over here today. And we will open this up. There it goes. I had to download one graphic over here. You would think it's China. So here is China's debt to GDP ratio, which as of 2022, according to Trading Economics, it's right around, I'll round it up and call it 80% debt to GDP ratio. 80% debt to GDP. And you're like, okay, well, is that bad? Well, it is when you take a look at what it is for the United States. So here is the United States debt to GDP ratio, which is right around 130%. So we are far worse than China is right now with regards to debt to GDP ratio. But it's funny, the whole world is now pointing over at China going, oh, China's going to die. They're going to crash. They're going to collapse. Like, I don't know. This looks a lot more manageable than the number that I'm seeing over here. All right, this one looks pretty bad. And when you look at this, what's interesting is, look when it really went nuts. Like, we were at 100% debt to GDP ratio back in 2013, 14, all the way through 2019. But as soon as COVID hit, you talk about putting ourselves into just colossal debt. And we went up to 128, and right now we're probably 129 on our debt to GDP ratio. You can get CJ to do my switching for me. So anyway, I thought you guys might find that interesting, just because I think, at least in my mind, I had this preconceived notion because of the headlines that you've read over the last couple months about China and their debt issues. Everyone's pointing at it going, oh, they're in trouble, they're in trouble, they're in trouble. And it's like, are they? Are they? I mean, certainly it's a bad situation for them to be in, but I don't know if it's necessarily that bad. So let me go out here and bring up one more. Let's go debt to GDP ratio for Japan. And I will go to the same site, so at least I have the same consistent source. That's Trading Economics. And this is government gross domestic product. Oh boy. So Japan, if you look at their Japan general government gross GDP, 263%. So let's see, who's worse there? So our poll was 61% you said the United States, 30% said China, so 39% said China. Japan's in a way worse situation, but if I have to look at an economy which I think I would trust more, China or Japan, I probably would go with Japan. I just don't trust the smoke and mirrors that's behind the curtains of China, at least at this point. So anyway, lots of charts and statistics out there. Do I think it's going to be that big of a factor for the U.S. markets? I don't. I think will it lead to a global slowdown? Yes, but is it a global collapse? I think that's what John or the other gentleman that sent the question, John and Joe, are asking. I don't think that this is going to be it's just going to crush. We're going to see global GDP drop by 30%. It's oh my God, sky is falling. I think that China will slow down. I think it may lead to a slowdown in global growth, and maybe a slight global recession, but I don't think it's that much of a catastrophe. I really don't. I think that they got ahead of themselves. You have a ton of empty buildings, which is just crazy. Watching, 8-lane roads with not one car on them because they're just not built. Brand new, beautiful stuff. It didn't hurt oil today. Oh, I did short XLE today too. I'm holding that one. I'm a slight loser on that at this moment, but I'll walk you through that trade here in just a second. There is your crude oil photo day. Started off actually going to my favor. I thought we'd actually see it head down, and nope, didn't do it. All right, let me see what other questions I had. I want to make sure I don't go too long today. As you guys know, I will be taking the next week off. Here's another question from Mark, and I think this ties to what we just discussed, but let me just make sure I give Mark credit because you sent the question in on the YouTube channel. He's drawing from your experience having significant past negative market condition or corrections been preceded by a higher percentage of news stories. I can't tell you I don't really recall if there's a higher percentage of news stories. I'll be honest, because I don't really like to focus on the news. I glance quickly at the headlines and then I go about my day. I try not to get influenced and swayed by what's going on with the news. That said, what I do notice, and I think this is almost a cliche thing in the financial world, that when all the headlines are pointing in one direction, that's when you have to think the opposite direction. And the biggest one for me with that was back in 2000. In, I think it was February or March, Money Magazine had right on the front page. It said The Great Boom. And basically you're missing out by not investing in these markets. And everything else at that point was, we are ripping all-time highs. This is the greatest market we've ever seen. Blah, 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 blah. And 90% of all the media was saying, go long, go long, go long. You're stupid if you're not buying. When that happens, I'm building short positions. Now, it's funny because one of my mentors, when that was happening, he kept building short positions and he kept shorting the Qs, more and more of the Qs. This is before we had leverage ETFs back in 99 and 2000. And he kept shorting and shorting and shorting, and he got to the point where he's just about to throw in the towel and get liquidated, and all of a sudden that market started to roll over. He was right. He was just a little bit too early on his forecast. So, Mark, I can't say that I look at the news headlines per se. I obviously glance at them, but I don't really dig into them. I don't particularly care. What I do look for is if everything's too biased. Right in a period of time where everyone's saying, oh, markets are going to correct and here comes the recession and doom and gloom, go long. Go the opposite of what most people are thinking. So the rest of your second part of your thing here says, given recent concerns like the banking sector, Chinese real estate, inflation, the potential government shutdown due to the debt ceiling, am I being overly sensitive? No, you can never be overly sensitive. Just don't start crying about it. Should the increase in FUD be taken seriously for long-term trades and retirement accounts? And if so, what steps should be taken? All right. I don't think you should ever look at anything and go into full-on panic mode. You keep hearing about the soft landing. You keep hearing about all-time highs. You keep hearing about market crash. Which way is it going to go? Someone's going to be right. The broken watch is right twice a day. So if you're looking at long-term positions, I think what you should be doing here, Mark, and anybody else who's in that position, is take a step back, look at your positions, and say, am I in good, solid, strong companies? If you're not, if you're in speculative stuff like what was it, VFS? That car company, VinFast? Man, I told you that thing would be below 30. Below 20, it's at $24 right now. If you're in stuff like this, okay, that's garbage. You should be afraid. But if you're in stable things, much bigger, that's why I like broader indexes, because it's easier to be stable with a broad index, then I think you're going to be okay over time. What I would do for myself is I would have a stop loss even on my investment portfolios, and I would trail it when the markets are strong, get out, and if the market does have a correction, I'll buy back in at cheaper prices. For some of you, it doesn't matter if it corrects, right? Your time horizon might be long enough. You're not nearing retirement, so hey, I'll ride a market correction. Great. I think the key with this is you need to have the right investments in your portfolio. The ones that you think will survive a bear market, not real speculative stuff. If it's real speculative, put stop losses in place so that you don't get hosed on those ones. So yeah, I would say active manage it, relax, don't get caught up in the headlines, don't get caught up in the fear, uncertainty, the doubt. I would say just go with it, relax, and either trail stop your portfolio position. So if it does go to hell in a handbasket, you'll get out and go to cash, or just ride it out. That's what a typical financial advisor would tell you, just to ride it out. That's not my style personally. I don't like to ride things out. I like to just be out of it and hopefully buy back in at a lower price. All right, I think that was it for my. Les, you asked a question about ETFs. I got a long answer for that one, so I need to do that on a separate day. Let me just run through our markets here, and we'll dive into what happened. So codes. I don't know that. Oh yeah. Codes for those buildings? Yeah, I don't know. I don't know anybody who's in construction in China. Otherwise, I'd ask them, hey, do you have any building things here? Lori, I will have a fantastic time in Jamaica. Absolutely. So let's start at the bottom. All right, I want to start at the bottom with a daily chart just because this is what the focal point was for me yesterday, is I wanted to see this roll over. Now, we did bounce back a lot. You guys can see that the way we bounced back near the end of the day, great, nice bounce back. However, we did break those lows. We are down below that 15,460 mark, which I think is great. I would like to see no bounce here at the end and more follow through to the south side. So that's all in all fairly good. Still makes me feel rather bearish because we are breaking demand zones. However, a little bounce back here at the end leads you to believe you're going to have some, rally back to the upside. Now, how far will that go? Here's your 15-minute chart. You can see really the second half of the day was giving back or recouping some of those losses. You had the early initial stuff where it just sold off dramatically, kept on going. I was loving this at that point. My IWM is still open, and so is my SPY. SPY was a great one today. I'll walk through the XLE trade here in just a second. Thank you, Joachim. I appreciate that very much. I'm in an all-inclusive resort, so I won't spend that $10 there, but I'll save that for a nice glass of whiskey somewhere, top shelves. Thank you very much. Appreciate that. So yeah, your NASDAQ, I love it. This is what I wanted to have happen today. I wanted more follow through, but we ended up ultimately down 0.87% for that NASDAQ 100. That's a great sign to see it roll over for anybody here who's bearish. So I think Lori or Lisa, you had some short positions on. That's great. S&P was down 0.69%. Even better. I like this one. This was doing great. I didn't like the bounce. I actually was targeting and thought we'd hit lower down here. And maybe by the end of the week we do get lower if we see this fear persist. So all in all, pretty good. Yeah, that short trade was good today, Big Eb. And it's funny because I've been wanting to hold these for a while. I wanted to get more follow through, but it's funny. I went through a personal dilemma today. Like right around 12:40, I was like, you know what? I want to go on vacation and not think about it and not have any positions open. But unfortunately, I've got probably 30 different things open right now, so I can't do that. And I was going to close out the IWM because it's a pretty big position, right? If you think 80 contracts that's a pretty good size. S&P is only 20, but I decided to leave it open, have a little more fun with it. We'll see how bad that bites me. If we get a huge rally next few days, and it could happen. But I left that one open. My target was definitely down here on that S&P, getting down to around 4,400, and we'll see if we get there. If I get to 4,400, I'll close that one out while I'm on vacation. Because yes, I will have alerts set up on that one. So there's your S&P down 0.69%. Gold also having a nice pullback. Now, I like what happened with gold because it came right back into this area we had talked about, which is right around 1945 on gold. Is it done? I look at this picture, which we drew out yesterday. I do still think that your probability is higher that it's going to traverse and get back down towards that 1900 level. So even though it's down near that 1945, 1940 mark, I do like it as a potential buy point, but I would wait. I'd wait for it. Moving on that list up, Russell continuing on. I have this head and shoulders that we drew out yesterday, all kinds of artwork. We have this yellow box, which I will remove. That was kind of the second leg of my trade, which from that point has been great. We'll see if this does continue on. That lower part here where I was aiming for was right around 1860, and we got pretty darn close to it today on the Russell. Russell today hit low price of 1865, and that's one of the main reasons I was thinking of taking some money off the table here just a little bit, just because it's coming right back down into demand. That's where I typically want to take profits, but I didn't do that today. We'll see if that bites me in the butt tomorrow while I'm on an airplane going to Jamaica. Hey, Pepe, thank you. Oh man, I can't do a toast with you. I have nothing to drink up here. I didn't bring anything. Cheers, toast. It should be the Friday show, right? Thank you. Cheers. I'll be raising a glass to you. What holiday am I going on now? Just my dad decided to take me and my brother and his girlfriend to Jamaica for a week. So I can't say no to an all-inclusive resort in Jamaica. So I will be enjoying that one. Should be a good time. All right, I'm still in the Russell. We already told you that. 10-year, here's what you had cooking for the 10-year today. Again, we talked about it pulling back. I thought we'd get down to the 4%. We didn't. Now, all of a sudden, it's rallying aggressively. Boy, keep your eye on that 4.35 mark. I think you're going to get back to the 4.35 and then continue on, and that should push these markets down lower. If you look at the pattern that's formed here, somebody asked me if this is an ascending triangle. I would say no. Not really an ascending triangle. Some might call this a cup and handle. But if you look at the psychology of what this pattern is telling you, right? I'll zoom out a little bit further here. Maybe do a weekly just to keep you from an explanation perspective. You know, if you look at this picture right here, remember, I am a big fan of candlesticks telling you the story between buyers and sellers and the end goal of those buyers and sellers. And you can see back here in 2020 when we were down at 50 basis points, right? 0.5% for that 10-year. Then it started to make higher highs, higher lows. And it feels like that is completely intact right now. I would argue that what you're seeing right now from October of last year to today is very similar to what you saw back in March of 2021 to January of 2022, right? You're seeing just a little pause, and then all of a sudden it comes back up, hits that high, maybe get a potential break, and then rip to the upside. So I'm definitely bullish on the 10-year. I think you're going to see yields surge here. That means you're probably looking at getting back up to these highs about 5%, maybe slightly higher than 5%, I think by the end of the year, which is not that far away. And again, that's jumping at about 70 basis points. If we do get that, that's certainly going to have an impact on the market. So there we go. No Katut, just a boys trip. And let's see, what else do I have on this one? I had three more. Bitcoin, who cares? Bitcoin's done nothing. It's been flat. You got almost 3 weeks in a row, except for that one big surge where they had the lawsuit win from Grayscale. Otherwise, Bitcoin's been boring, really boring for a better part of 3 weeks. So nothing exciting there. Your dollar index continued to surge as well today. We had that 104.70 mark mapped out. Why? Because it's this peak that we saw back in May of 2023. And also going back here into March. We kind of double tapped that. Now we broke it, which means to me, we're going back to these highs that we saw on March 8th of this year. That's going to bring you to right around 106.60 or 106.70. And after that, we can start looking for some higher levels. So all in all, these two things, the 10-year yield surging, the dollar on an aggressive rally, does not support being bullish on the equity markets, which is why I have a bigger short position. And if I was not going on vacation, if I was staying here and I had some follow through, I'd be building and getting a bigger position on the Russell and the S&P and maybe even the NASDAQ, but still not feeling like shorting the NASDAQ quite yet. And lastly, your Victor, crude oil, continuing its absolutely stellar run. We had that kind of a hesitation day yesterday, even though there's a lot of volatility. Today, kept on rallying to the upside. You had a 0.98% move up for crude oil on today's session. The question now becomes, where are you headed? Right, where are we actually going with this one? And if I look off to the left-hand side here, there is a level that's slightly higher, which is right around $89, and we're currently at $87.50. So all in all, I think you got a little bit more upside here. Now, the question I think was posed earlier was on my XLE trade. So I talked about shorting energy yesterday, and it actually was panning out today. I want to walk you through, not that I'm actually losing on this trade at the moment, so it's not anything I'm boasting about, but I want to show you the logic here, because one of the things I've shown is how I'm a stickler for rules with my own trading. How you guys make your rules is on you, right? You have to make your rules your own, own it, follow it, and go with it. Somebody asked me on the Online Trading Academy YouTube page, is this like gambling? And I go, if you have a trade plan, you have very specific rules that outline what you're supposed to do, when, and how, I don't believe it's gambling. I think it's a probability game, but it's not gambling in my mind. So with this one, I had this red line at the top. Let me get these ones out of here just so we can have one line on the screen. There's one red line at the top, and that is at $91.16. So my rule is what? It has to open above it and then come back down. Well, look what happened right in the open. I'll do a 5-minute time frame here. And right as it opened, it actually opened below it. right? You can see this line right here at 6:30. It actually opened down below 91.16. So that's a no trade. That's a do not take this trade, even though it's below it. My rule is it has to open above and then come back down. So with this one, what was interesting for me is there was no trade on the open. It rallied up above, and this is why I had those rules in place, because it could have kept on rallying. But then it started to drift lower, and you can see here on my clock, right around 7:35, it dropped back down below 91.16, so that's when I opened my short position. So right around 91.16, a little bit of slippage in there is where I opened my short position on XLE, and it was working great. It looked nice, had a nice tiny little profit going, but then all of a sudden went sideways and ultimately came ripping back up and put me in a losing position for a little bit. Not like it's that dramatic. I'm not worried about it. It's not a huge position. I didn't want to open anything monstrous before I went on vacation. So we'll see how this one pans out. But just wanted to explain that with you just so you can see the logic as to why I didn't take the open here. Because it opened below 91.16. And my rule was it has to open above it and then cross below, which it did at 7:35. So there you go. But you don't get free drinks when trading. It's true. Depends where. That's true. Margaret, I love that you say that. You said you don't get free drinks when you're trading. They're anything but free, right? Those drinks when you're playing up a casino are some of the most expensive drinks you're going to get. Last time I went up there, I went to this bar, and if you play the video poker machines at the bar and you have money in when you order your drink, they comp you the drink, right? So I ordered like a Crown and Coke, just a simple cocktail, and I'm sitting there, and the Crown and Coke was probably $10, $15. Let's call it 15, be generous. But I had $100 in that poker game. I proceeded to lose the whole $100. I'm like, that's the most expensive Crown and Coke I think I've ever had. I wonder how much you, Merlin, make on those big option trades. Well, I'm not going to tell you. You guys can do the math. You can see the numbers. I told you when I'm in and the quantity, so you can kind of figure it out. But I don't like to boast gains or losses. I'll talk about, but I don't like talking about gains. Post your account logins here, and we'll take care of your trades. Tom, I would trust you, Tom, but no one's getting my access to my codes or my accounts. We'll have to say. It's funny because I'm literally going to be sitting by the pool, I know, watching some of these trades because it's kind of hard to not think about an 80 put options on an ETF like IWM or SPY or something like that. Those can be pretty big positions. All right, where are we at? 233. So that was our major pieces I wanted to talk about. There's one other thing here. We talked about buying yesterday, and the show was like, is it a day to buy? And I said, it all depends on your objective. There is a couple that are hurting me right now, and I did sell. Remember, I'm long put, so I bought puts directionally, but I also sold the 185s, and I wish I would have done that today, because it would have been a much better trade for me. But we'll see. I've got until next Friday for those to expire worthless. I sold the 185s. In a perfect world, what we'll get is it closes right around 185.01 next Friday. But we'll see on that one. And SLV also, I was actually going to sell some more puts on SLV at $21 a day, or $21. I had the 2150s, so now I'm down below that, and those also expire on the 15th. So we'll see how that one pans out. Just letting you know. What about Larry? We got to get Larry a vacation. Larry doesn't take vacations. Larry just likes to work and work and work. John, I will be back on the 13th. I'll be back on the 13th. Sold October 6th, $20, 2050 SLV puts today, 1.1 for October 6th. So you gave yourself, great, 1.1% for a month. I think you're probably okay with that. And it's silver, right? If you're at the 2050s? You say, 2050s? Great. Where are you at? You're right down here at the bottom point of this sideways action. So I think that's a great one. I've just chosen the shorter time frames just because I don't want to. Again, I mentioned this before, but knowing September and October's history, I don't want to be going out and selling puts that far out. Normally, I'm fine with 30 days, not a problem, but I'm being a little bit cautious by selling weeklies or maybe 2 weeks time frame. Let's see. I sold a put on SLV, 2050 strike for next Friday, and sold puts on Kiki today. Yeah, well, I think you'll be okay. I actually do think you'll be okay with the 2150s on SLV. I think you're going to have a little bit of a bounce back up here, even though it's, the logical part is going to close this gap right around 2086, maybe touch that 2050 mark. But I'm fine owning a 2150. We'll be good with that one. I count 16 different 13G filings on the company website, which beat earnings of 24 cents and was a penny stock, which, great earnings. Yeah, well, I mean, this is not that type of, that ain't me. You know, I don't care about 13G filings. I don't care about their earnings. I care about the price chart. And again, you know, we look at PAGs here, PAG Seguro, Digital Limited. I don't see any reason to get excited about it. What's price doing? It's trending down. It's going lower lows, lower highs. So I don't care whether they have the greatest earnings on the planet, the most amazing product or service, and the most epic CEO or management team in the world. It doesn't matter, because that's not what I'm trading, right? I'm not buying the owner. I'm not buying the products and services of PagSeguro. I'm buying the price of that stock at that moment in time. And my goal, if I buy it, is it's going to go higher. And right now, momentum tells me PagSeguro is going lower, regardless of whatever they release to the public, whatever they file with the SEC. It doesn't matter. It's all about that price chart. And again, you know, for Michael, I love that you look at all that stuff, but here's the interesting thing for me. You can spend all your time looking through the 4 filings, all the SEC filings, go through the Edgar database. You can look through their income statements, their balance sheets, all that stuff. And maybe that'll impact your investment decision in something like 5 or 10 years, but I'm not thinking that, right? I'm thinking maybe the next days, weeks, possibly even months is probably the longest time horizon for me to think about a trade or investment. So for that, I can absorb so much information by looking at the fundamentals and earnings statements and press releases and news release. All that stuff is designed to manipulate you, in my opinion. The easier thing is to just look over here and say, I don't even know what this company does, but I'm not interested in buying because price is going down. And remember, you're not buying their product. You're not buying their management. You're not buying their anything, except you're buying the share price and assuming it's going to go up based off those other factors. So. Let's see. What do I got, Tom? Does that mean when you travel, you're going to trust me? There, yeah, exactly. Yeah, we'll trade your account for you, Tom. Yeah, you just leave us your login. You're good. What was one of the other ones that we were looking at? Oh, there was the VIN FS, but there was something else that we had checked out recently. I think it's a GameStop. So GameStop came out with earnings today. Let's check out GameStop. Here's GME. Was down 2.5% today. And then after hours, you're up 6.4%. Their earnings call was, they lost 3 cents. They're supposed to lose 14. They lost 3. They're still losing. Look at every quarter. Let's go back here. I'm just going to go back and pick on GameStop yet again. So the most previous quarter, they lost 3 cents. Before that, they lost 16 cents. Before that, they lost 16 cents. Before that, they lost 31, 35. 52. They're getting better. They're actually getting 48. These are all losses, by the way. 34. They haven't made money in. Hold up. Hey, they made money back here. They made 29 cents per share, and that was probably some restructuring of debt or some other weird mumbo jumbo thing that happened. But that was back in 2021. They actually had a positive earnings announcement. Can you believe it? Holy cow! Other than that, this is garbage. GME, yeah, there's AMC. AMC has been a wild one. What are we down today? Oh, down to 38%, 36% today. Wah, wah. Not good for anybody who's holding AMC. Yeah, it's not just a mall stock. They sell games. I mean, you know, I made this point with the music when we talked about how we used to buy music. Look at the Warehouse. Remember the Warehouse or Tower Records? Right now, Tower Records is ironically an interesting story because what are they doing? They're going back to actually selling records because it's kind of this niche market that's booming again to have vinyl. But nobody's buying CDs anymore. Right? You're not downloading MP3s anymore or buying MP3s. You just go to Spotify or YouTube and get all your content there. So it's an evolution of a business model. You know, why did Blockbuster go under? Because no one rents DVDs anymore. You're streaming everything. Well, games are no different. So to me, and we mentioned this so many times, GameStop is going to go the exact same way of Blockbuster. Now, AMC, I think, is very different. It's physical movie theaters. People still love that. I can't stand it. I refuse to go to the movie theaters unless it's something I absolutely have to see, like Maverick. Right? I want to see that in a giant surround sound with rumble seats. Other than that, I can't stand movie theaters. It drives me nuts when I see these 15-year-old kids on their cell phones the entire time, and I got to stare at some glowing light there. It's like, get off your damn phone for 2 hours. Just leave it alone. Anyway, GameStop is racking in $1 billion in revenue per quarter. Somebody can fix that. Let's see. Not getting better. They're getting less bad. Exactly, Pepe. I wouldn't touch GameStop anyway. All right, I'm going to wrap things up. So it is, it's Wednesday today. I may, if I have some weird inclination or make some action on my trades, I may just do a spontaneous live stream just for fun, but I don't expect it to be a long thing. Obviously, I'm going to be by the pool, enjoying relaxation and all you can eat. Now, just so you know, I will be stepping on the scale when I leave my house today to see what I weigh before I go there. And I definitely want to know how much I weigh when I come back. I'm going to do my best to actually hit the gym because they do have a gym in this place. Maybe I can actually help myself out. I've been pretty bad about that lately. But if I've got nothing to do but eat, swim, and exercise, I think I'll get some exercise done. So that's going to be, Michael says, I never made money on a stock after it has a reverse split of death. Yeah. And then this one's had multiple reverse splits of death. It's funny because people think split is good, it's going to go up. No, I think reverse split is generally going to be bad for it. I go to the theaters to watch old movies, no kids on cell phones. They're good. Good. I can't bring myself to do it. Okay, so this is the final show for the next week, unless I just happen to do a surprise thing. Remember, I have no studio over there. I'm not going to have any microphones or anything like that, so if I do a show, it's going to probably be pretty bad. I may go do some hikes and see what that's like and just enjoy Jamaica and spend some time with family, which I have not done very often, so it should be a good time. I hope you guys have a fantastic remainder of your week. Again, if you have topics or things you want me to discuss, you can always email me, TraderMerlin@gmail.com, or put them down below YouTube videos, and I will get to those and hopefully have a whole lot of new content when we come back. Maybe I'll be all new, refreshed, make no errors or anything like that on this program. Yeah, that's probably not going to happen. Anyway, I will talk to you guys soon. Thanks for all the support, and I look forward to a good vacation and being back here in a week. So take care, everyone.